All right, let's dive into the exciting world of options trading. It can seem a bit daunting at first, all those formulas and jargon.
It definitely can be.
But, with the right guide, it
Absolutely.
can actually become pretty clear.
We're going to break it all down, make those intricate concepts, crystal clear.
And our listener today is a student
Yeah.
who is just starting out in this world.
Wants to learn it all.
So we're going to approach this like a master class, really breaking it down.
Repetition, yeah.
Repetition, using clear and engaging language.
Exactly. Making sure you can listen to this, several times.
Yeah,
Come away feeling really confident
absolutely.
about options.
And we've got a fantastic textbook for this deep dive, Dan Passarelli's Trading Option Greeks.
It's a fantastic resource.
Really gets to the heart of what makes options tick.
So, since you're starting fresh, we'll start with the basics.
Yeah.
Calls and puts, those building blocks of options trading.
The ABCs.
Yeah.
Okay, so then we're going to demystify option pricing.
That's right.
It's not just about supply and demand, right?
There are other forces at play.
There's some hidden factors, like time,
Yes.
interest rates,
Interest rate.
and those mysterious Greeks everyone keeps talking about.
The Greeks, we're going to break them down, make sure you don't just memorize the definitions.
Yeah.
We'll help you understand what they actually mean and how they're used.
In the real world.
That's right.
But by the end of this, you should be able to look at an options chain and not just see like a jumble of numbers,
Yeah.
but see opportunities and understand the risks involved. Ready to unlock this powerful financial tool.
Let's go.
Let's dive in.
Okay, so calls and puts. Think of options as contracts. They give you the right, but not the obligation to buy or sell an asset, like a stock, at a specific price.
Okay, so I've heard this analogy before, but it always helps me. It's like having a reservation at a restaurant.
Yeah.
You have the option to show up, right? But you're not obligated.
Perfect analogy.
So, with calls, you're reserving the right to buy. So let's say you think a stock is going to go up, right?
Yeah.
You could buy a call option, which gives you the right to buy that stock at a certain price, the strike price, by a certain date, the expiration date.
Exactly.
So if the stock price goes above the strike price,
Uh-huh.
I can exercise my call option, buy the stock at the lower strike price,
Yep.
then sell it at the higher market price, and bam, profit.
You got it.
All right. And then on the flip side, we have put options.
Yep.
These give you the right to sell. So if you think a stock is going to go down,
Uh-huh.
you could buy a put option.
That's right.
And if the stock price falls below the strike price,
Yeah.
I can exercise my put option, sell the stock at the higher strike price,
Uh-huh.
buy it back at the lower market price.
Right.
Profit from the stock going down.
Exactly.
Right, that makes sense.
But here's a really important point. Owning options isn't the same as owning the stock itself. It's just the right to buy or sell.
Right, the right to buy or sell at that specific price.
Uh-huh.
Okay, so we've got calls, the right to buy.
Yep.
Puts, the right to sell.
Puts, the right to sell.
But what determines the price of these options?
Yeah.
Is it just supply and demand?
It is a factor, but it's not the whole story. The price you pay, known as the premium, is influenced by a bunch of different things.
Like what? Break it down for us.
So first off, you got the price of the underlying stock. That's a big one. If the stock price goes up, calls become more valuable, puts less valuable, and vice versa.
Makes sense. It's all about that potential profit, right?
Exactly.
Okay, what else?
Then you have the strike price. The closer the strike price is to the current stock price, the more valuable the option.
Got it.
And then there's time until expiration. The closer you get to expiring, the less time value the option has.
Time is literally money.
Literally money.
Okay, what else are we missing?
You got interest rates.
Okay.
Higher interest rates generally make calls more expensive, puts cheaper.
Why is that?
It's like factoring in the cost of borrowing money to buy the stock.
Oh, okay.
You also have dividends.
Dividends, yeah.
If a stock pays a dividend, the price usually drops by the amount of the dividend on the ex-dividend date. Now, if you own a call option and the stock is about to pay a dividend, it might make sense to exercise that call early to capture that dividend.
So even if the stock price isn't above the strike price, it might still be profitable to exercise early if a dividend is coming.
Exactly.
Interesting. So that brings us to this concept of, price versus value.
Right. We've been talking about theoretical value, like all these factors that contribute to what an option should be worth.
But the market doesn't always agree, right?
The market has its own ideas, and options, like anything else, are worth what the market is willing to pay. That's market price discovery.
So even if all the numbers say it should be worth X, the actual price can fluctuate based on what? Supply and demand.
Yeah, supply and demand, sentiment, all sorts of things.
So we've got the underlying price, the strike price, time until expiration, interest rates, dividends, all these factors.
It's a lot to keep track of.
It's a lot.
But there's one more crucial factor we haven't even touched on.
Okay, hit me.
Volatility.
Volatility. Isn't that where the Greeks come in?
You got it. Volatility is huge in option pricing, and the Greeks are the tools that help us make sense of it all.
Okay, things are getting interesting.
They are.
We've got our calls and puts, the forces behind option pricing. Now we're ready for the Greeks.
Let's do it. All right, so the Greeks. Time to unlock their secrets.
Okay, the book mentioned delta, gamma, vega, theta, and rho, a whole fraternity of Greek letters.
Yeah, there are a few.
Where do we even start?
Let's start with delta.
Okay,
It's the most important one. It measures how much an option's price is expected to change for every dollar the stock moves.
so if a stock goes up by $1 and the option has a delta of, say, 0.5,
Yep.
the option's price would go up by 50 cents, theoretically.
Exactly. Think of delta as a measure of like how much it's going to move.
Sensitivity.
Sensitivity, yeah, to the underlying stock.
So a higher delta means it's going to move more dramatically.
Exactly. Deltas for call options range from 0 to 1, while puts range from 0 to -1.
Okay.
So a delta of 1 means the option will move in perfect lockstep with the stock.
So a call option with a delta of 1.
Uh-huh.
If the stock goes up by $1, the option goes up by $1.
Exactly. And a put option with a delta of -1, if the stock goes down $1, the option goes up $1.
All right, that makes sense. So delta, we've got it. It tells us how much the option price will change based on the stock price. What about gamma?
Gamma's all about acceleration.
Okay.
It measures how much the delta will change as the stock price moves.
Wait, so delta tells us how much the option price will change, and gamma tells us how much that change will change.
It's a little bit meta, I know.
My brain's starting to hurt.
Let me give you an analogy. Imagine you're driving a car, okay? Delta is your speed, gamma is your acceleration.
Okay, so if I'm cruising along at a steady speed, my delta's constant. But if I hit the gas, my acceleration, or gamma, kicks in.
Right.
And my speed, the delta, changes really fast.
Exactly. So in the options world, if a stock suddenly takes off, high gamma means the delta is going to increase quickly, giving you even more leverage to the upside.
So gamma can amplify gains and losses.
Exactly. That's why understanding gamma is important for risk management.
Okay, I think I'm starting to get a handle on delta and gamma.
Good.
We've still got a few more Greeks to conquer, right?
We do. Next up is vega, my personal favorite.
Vega.
Vega measures an option's sensitivity to changes in implied volatility.
Hold on, we haven't really talked about implied volatility yet.
Oh, right.
Can you give us a quick refresher?
So implied volatility is basically the market's expectation of how much a stock's price is going to fluctuate in the future.
Okay, so if there's a lot of uncertainty, like everyone's expecting big news or something,
Yep.
implied volatility will be high.
It'll be high. Like, imagine there's a hurricane coming.
Okay.
The implied volatility of, like, umbrella stocks.
Right.
It's going to go up.
People are going to be buying umbrellas.
Exactly. Their options will be more expensive.
Okay, so Vega tells us how much an option's price will change in response to changes in this implied volatility.
Exactly. So high vega means the option is very sensitive to changes in implied volatility.
So even if the stock price doesn't move that much, the option could still go up in value if volatility spikes.
Precisely. It allows you to kind of speculate on the market's expectation of future price swings.
All right, Vega, got it. Another Greek down. What's next?
All right, now we're getting to the one that can be a real heartbreaker for option buyers. Theta.
Theta. The book called it the silent killer, right?
It's a good way to put it. Theta measures the rate of time decay in an option's value.
Time decay was that?
Remember how options have a limited lifespan? They expire.
Right.
So as time goes by and you get closer to that expiration date, the option's value starts to erode.
So theta is essentially the amount of value an option loses each day, just because time is passing.
Pretty much, yeah. Imagine it like an ice cube melting.
Okay.
Theta is the rate at which the ice cube melts.
And this is always working against the option buyer, right?
That's right.
Because that expiration date's coming.
Yep. Option sellers, on the other hand, they love theta. They're essentially collecting rent as time passes and the option loses value.
Okay, so theta, the relentless march of time.
Exactly.
All right, what's the last one?
The last one is rho, and it measures the sensitivity to changes in interest rates.
Interest rates again. How do those affect options?
Interest rates can affect options prices because they impact the cost of carrying a position. Higher interest rates usually make calls more expensive, puts cheaper.
So rho's all about factoring in, like, the cost of money.
Yeah, you could think of it that way. Rho's usually the least impactful, though, especially for short-term options.
Okay, so we've covered all 5 Greeks. Can we do a quick recap just to make sure our students got it?
Sure, we started with delta, which measures sensitivity to the stock price.
Right.
Then there's gamma, which tells us how much that delta is going to change.
Acceleration.
Yep, the acceleration. Then we've got vega, which measures sensitivity to implied volatility.
Volatility expectations.
Yep. Theta, the rate of time decay.
The silent killer.
And finally, rho, sensitivity to interest rates.
Wow, we really covered a lot. But how do we actually use these Greeks in real-world trading?
That's a great question, and that's where things get really interesting, because they're not just theoretical concepts. They're tools that traders use every day to make decisions.
Okay, so how do traders actually put them to work?
They can help you select options that align with your market view and risk tolerance. So, for example, if you think a stock is going to move a lot, but you're not sure which way,
Okay.
you might look for options with high vega, anticipating volatility to increase.
So if I'm bullish on a stock, but I want to limit my risk,
Mm-hmm.
I could sell a covered call.
Exactly, because you already own the stock.
Okay. So the Greeks can really help tailor your strategy.
Exactly. And they can help you manage your trades as the market changes. So it's not just about picking the right options. It's about actively managing your position.
It's like they're a framework for navigating this complexity.
Exactly. By understanding how they interact, how they're affected by the market, you can make more strategic decisions.
I'm starting to see the light here. The Greeks aren't just random variables, they're essential
You
tools
got it.
for navigating this world.
We're going to dive even deeper into how to use those tools when we explore trading strategies.
Okay, can't wait to see how they play out in the real world. Okay, so we've covered a lot of ground, but how about we look at some real-world trading strategies?
Let's do it.
We've got calls and puts down. We understand those Greek letters, so let's see how it all works together.
Okay.
How about we start with covered call writing?
Covered calls, yeah, a very popular strategy for both beginners and experienced traders.
Okay,
Imagine you own 100 shares of a company, say Apple.
all right, Apple, yeah.
With a covered call, you sell a call option on their shares.
Okay, so I'm basically giving someone else the right to buy my Apple shares at a certain price. Why would I do that?
Well, by selling that call option, you receive a premium upfront. It's a way to generate some income from your stock holdings.
So it's like I'm renting out my shares for a bit.
Exactly. That's a great way to think about it. Now, if the stock price stays below the strike price, the option expires worthless, and you keep both the shares and the premium.
Sounds good to me, but what if the stock price goes above the strike price?
Well, if the price goes up, the buyer will likely exercise their option, and you'd have to sell them your shares.
Ah, okay, so I'd have to sell them even if the market price is much higher.
That's right, your upside is limited to the strike price.
So it's a way to generate income, but with like a cap on potential profit.
Exactly. It's a more conservative approach.
Okay, that makes sense. So how about buying calls and puts then? When would I use those?
So buying calls, that's a way to bet on a rising stock price. Instead of buying 100 shares outright, you could buy a call option that controls 100 shares for a fraction of the cost.
So if the stock goes up, my profits are amplified.
Exactly, because you're controlling a larger position with less capital.
But leverage works both ways, right?
Of course it does. If the stock goes down, you could lose your entire investment.
High risk, high reward. Got it. What about buying puts then?
Buying puts is the opposite, right? It's a bearish strategy, so you're betting on the stock price going down.
Okay.
Or you can use it as a hedge. So if you own shares and you're worried about a potential drop,
Yeah.
you can buy a put option as insurance.
Oh, I see. So if the stock price tanks, the profits from the put offset the losses from the shares.
Exactly. It's like an insurance policy for your portfolio.
Okay, so puts, you can profit from falling prices or protect your holdings. All right, what other strategies should our student know about?
Well, how about straddles and strangles? These strategies involve buying both a call and a put option on the same stock.
Okay, so I'm betting on a big move, but I don't know which direction.
Exactly. With a straddle, you buy both with the same strike price and expiration date. The bigger the move, the more profit.
So it's like, I don't know which way, but something big is going to happen.
That's a good way to put it. Now, a strangle is similar, but you buy options with different strike prices, usually out of the money, so it's cheaper.
Okay, so a strangle is a bit less certain about the size of the move, but still expecting volatility. Now,
Yeah.
how about those Greeks we talked about?
The Greeks?
Yeah, delta, gamma, vega, theta, rho.
Ah, yes. Those are essential for understanding all these strategies. For example, if you're buying a straddle, you want high vega because you're betting on that volatility increase.
Okay, and if I'm selling a covered call, maybe I want high theta to benefit for that time decay.
Exactly. They're practical tools.
It's all starting to click now. The Greeks help you understand the risks and the potential of each strategy,
That's it.
and even guide your trade management.
Options trading, it's a dynamic process. The Greeks help you navigate all that.
So we've learned about calls and puts, the factors that influence their prices. We've mastered the Greeks, and now we've got this toolbox of strategies.
We covered a lot.
That's a lot.
It is, but remember, it's a journey, not a destination. Take your time, practice, and never stop learning.
And start small, manage your risk.
Absolutely. Options can be very rewarding, but you gotta approach them with caution.
Well said. I think that's a wrap for our deep dive into the world of options trading.
I hope you found it helpful.
It's definitely been insightful.
Remember, knowledge is power in this market.
So keep exploring, keep learning, and happy trading, everyone.